So why don't we, because it is Friday, although it is a great Friday, let's go ahead and get started. So you all, welcome back, and thank you for agreeing to do the meeting this evening so that we don't miss a month for our Financial Investment Club meeting. So we are super excited. We remain excited about what we're seeing in the activity that you all have been putting forth to work with your teams on a regular basis and to put your money away. So hopefully we are learning throughout the process. Jennifer and I have been talking, and we are overjoyed with the amount of effort that was put into your first presentations. So it far exceeded my expectation. I think Jennifer's too. We were really, really so impressed with what Spelman women did in this particular piece, although we probably should not have been surprised at what our sisters did as they came together talking about their financial freedom. So with that, what we're going to do tonight, let me just run through the agenda quickly. And we're going to go through our team presentations, just like we did before. Everyone will have about 5 minutes to do that. And that's covering your mutual fund picks. We're also going to go over your club or team performance. And I think that's going to take a little bit more than 5 minutes because we have some observations that we have seen for your stocks. And Jennifer also has a couple of comments that will probably move at the top of the agenda related to what you did for your mutual funds. Then we're going to transition into our expert presentation on how to evaluate Reits, real estate investment trusts. And we have representatives this evening from Bank of America. So we have a familiar face that has been with us the entire time, and that's Tiffany Eubanks Saunders. And we also have another expert with us this evening, and her name is Mary Stokes. And I believe Mary is in the Atlanta market. So we will hear from them, and then we'll close out this evening. So is everybody good with that?
Yes.
All right. So Jennifer, let me turn it over to you. And let's just talk just a little bit about the mutual fund presentations before they launch into those based on some of the feedback that we received since our last meeting.
So thank you, ladies. You all look lovely, and we certainly appreciate you guys getting on this Good Friday. So let me stop sharing so that, okay, we can all see each other. One of the questions that we wanted to make sure that we addressed up front that we started getting a lot of feedback on was when you all started doing your research on the mutual funds. I got a bunch of messages on, oh my God, the minimum investment is $1,000 for a lot of the mutual funds. And so, you know, when Adrienne and I provide you guys with a list of investments to evaluate, that is just a quick and easy way for you all to either take something on that list and explore a bit more about it, or go on your own or look on your own trading platforms and go seek out, you know, whatever that investment may be based on your trading platform. And so each month we've given you guys a list. You know, the first month that we kicked off, we gave you a list of stocks. And some of you said, hey, should I use these? We were like, whatever you want to do. With the mutual funds, we gave you like a list of 25. And at the time, what wasn't vetted was the minimum investment amount. And so I apologize about that. But up front, you guys should have, and we tried to address it right quick about a week out, that you could go on whatever platform you were using to execute your trades and search for mutual funds, and then do filter that by investment minimum. So whatever your budget was to invest that you agreed on, that should have been a pretty easy thing. And so we wanted to make sure that although that might have thrown you a little bit, that you should have still been able to go and research some mutual funds. And then also your team should have made a recommendation that you guys went ahead and executed. Okay. So we just wanted to address that up front. And then the other thing, Adrienne, is while we can, is that in the investment tracker, and should I pull that up, Adrienne?
Let's pull that up, because we'll just reorder this We'll switch that to now, Jennifer.
Okay.
Let's show the investment tracker and let's share some of the observations that we had.
All right. So let me.
It seems like people are still coming on.
Yeah. So I wanted to give
Get
some
to that.
time to make sure the teams could actually have whoever their presenters are. Okay. So here is the combined investment tracker. So this takes a look at each of the teams. And I'm sorry, I should try to minimize this. In
Do you want
terms
to
of,
start and go through, or do you want me to?
no, you can go ahead and go through.
Okay.
Yeah.
So first of all, ladies, what we are really excited to show is the amount of money that you all collectively are putting into the pot. So just with your first picks from stocks, you put in about $6,000. And that's phenomenal, because when we started this out, we had very broad guidelines. A minimum of $100, a month was the request. Some far exceeded that goal in that first month. And in addition, we asked that everyone on the team makes their investment. So a couple things that we want to point out. Number one, each individual on your team should be making a contribution. Okay, so we shouldn't be skipping weeks or months. There are some people that have chosen to invest weekly, which is great, because when we talked about dollar cost averaging, right, you can really see the impact. And I'm going to show you an example of that. But in addition, so to that $6,000 that was put in for the teams combined, the total value has already grown 3.7%. So that is just in 1 month's time. The picks that you all have made have grown to that level. There are a couple of outliers that we want to point out. Number one, it does not reflect everyone. So for example, if I look at the stock queens, Crystal Sidbury, I was saying, your choice or your pick, what you invested, is not reflected there. There are other teams as you scroll down. I think there were only a couple of individuals that chose Under Armour that put in. It wasn't everyone. T-Mobile, it seems as though they're all reflected. PayPal, I'm not sure if all the members of their team are reflected. And then the ExxonMobil, blessed beyond measure, it seems as though those all may be reflected. So I think that is a great way for us to be celebrating, right, the collective power of our investment as Black women. And so I'm super excited to see what that's going to look like by the time we get to the end of June and we see the other picks that we've been making. So that's first. The second thing is, if you look at the name of the individual that is actually in bold, what I wanted to show you is that these individuals who made their picks, I'm guessing earlier, instead of waiting until the end of the month, they had more appreciation take place than someone that may have made their purchase, at the end, because their money, they had more time. So for example, if you look at Beth Sapp James, she purchased 3 different times. So it looks like she probably did it each week, putting in just a little bit more. And so for her team, you'll see that she had a 2% return based on the money that she put in, versus everyone else on the team that purchased on a particular day and time. Their money did not appreciate, their stock did not appreciate over that time period. So we always want to keep in mind that the longer your money is working for you, the more of an opportunity it is to get a higher return.
That's right.
In addition, the second lesson is the more often you put in and start building that discipline, weekly versus just monthly. Again, the same thing comes into play, especially if, we started out with you all looking at the types of stocks that you were going after. If you are choosing a stock that is expected to grow over time, those principles will hold in place so that you're able to amass those dollars. The other piece that I wanted to look at is, we talked a little bit about ExxonMobil. The energy stocks really, really appreciated over the past month. And Exxon, their overall return for their team was about 5%. where the overall average was 3.7. And I believe that they're still missing members of their team who may have also put money in. So great job for them. Kimberly Murray, it looked as though you probably put yours in earlier and you also included a little bit more money in it. So your return was 9.7%. Robin Stokes for the Spelman Blue Chicks on your PayPal. It looks as though yours was higher than the rest of your team at 3.9%. And then I read a curse for T-Mobile. Looks like you had a 7.3% return based on what you all put in. So we just wanted to point out those observations as we move forward, because I thought it was kind of cool. I love to see how the money starts to add up over time. So collectively, we've made over $220. And again, that's at 3.7% return, with a total value of all the accounts at $6,200 almost $50. Jennifer, is there anything else that you wanted to add to that?
Absolutely. So, we will have a more accurate tracker once the rest of the team members add in their trades. Let's make sure those are updated and they're updated often enough. But also what goes into calculating your return is also the purchase date, which we initially left off the sheet, but we've added it now. So you will see that in your individual trackers, that there is a purchase date column now. So make sure you go back and when you reconcile, just put each of the dates that you purchased your stocks on to make sure that we can calculate a more accurate return on that, okay? And the only other thing was just a comment. Some of you guys may have seen and may have been hopefully keeping track of your stocks. Adrian mentioned energy stocks had a pop, and over the last month they did. Consumers are feeling more confident about people getting their vaccines and people traveling more and getting on the road for spring break and also for summer. So you saw energy stocks have a bit of a pop over the last month. But then, those of you that invested in tech may have seen the reverse a little bit, right? And so hopefully some of that made you want to question why that was. And so for those of you that looked at tech, the big tech stocks or the FANG stocks, what they call, Facebook, Apple, what's the other A stock? Amazon, Netflix, and Google, all, were, most of those guys were testifying, over the last couple of weeks over, are they monopolies? How are they going to change their businesses? And so that, that stuff had an effect on their stocks for a little bit. So hopefully, whether you saw an appreciation in this last month or whether you saw, you were flat or you guys went negative, that hopefully made you want to find out what's going on with your own stock, right? Because you want to ask questions and questions are good. Are there any questions about any of this that any of you all have?
No questions?
No questions? Comments? Observations real quick?
Yay, us.
Yay, you.
Yeah, yay us, exactly. So, okay.
I have a comment.
Go ahead.
I have a comment. I'm just impressed at what we can do in 1 month. So in the next 3 months, I'm just anticipating us reaching $1,000 by then, or even over $1,000.
Awesome.
It is definitely possible. If there aren't any other questions or comments right now, I want to just introduce, we have a new person joining that we will place on a team, and that is Dawn Griffin. She is joining the Financial Investment Club. So yay, Dawn, and welcome. We will make sure that we get you with a team and get you caught up so that you can make your stock purchase, Dawn, as well as the mutual fund piece. And so we'll put you with a team, and Jennifer, maybe you can look and see where we might be short so that she can meet those ladies as we move forward. Okay. So for this next piece, so that we can stay on time, let's do a roll call for the teams, and let's have our volunteer for the first presentation. So Blessed Beyond Measure, are you all here?
We are, however, our presenter just sent her a text message.
Okay, we will wait for them.
Thank you.
Jennifer, I need help. We took
Yeah,
down.
I'm pulling it up right now. Okay, so we have the Spellman Blue Chicks. Are you all present and ready?
Yes.
Perfect.
All right. So we've got, okay, so everyone's there and we have a presenter, and then we have Team Legacy Builders.
Suzette, or is that?
We're here.
We're here.
Okay, and then we have the True Blue Novices.
Here.
Yep, we're here.
Perfect. Okay, so and then Stock Queens.
We are here and I can go first.
All
Okay,
right, I love
Queen,
that.
let's go.
All
Yay,
right.
Star Queen!
Yay!
Let's get it.
All right. All right. Good evening, Spellman sisters.
Evening.
We are the Stock Queens, and we are here to present our mutual fund recommendations. So just a quick reintroduction. We are Chandra Armstrong, Camille Sanders Patterson. Oh, let me take this title off. Chandra Armstrong, Camille Sanders Patterson, Crystal Sidbury, Beth Stapp James, and myself, Cassandra Bennett. And as you recall, last month, we made a stock choice of Apple. Through it all, we just couldn't deny the importance of technology with what we're facing now. So it would only make sense that our mutual fund selection would be Putnam Global Technology Fund. We chose Putnam Global Technology Fund for various reasons. Their objective is growth, and we were seeking growth. It is in the global technology sector, and technology is a thing, love it, hate it, we all got to use it, right? So they invest across the entire universe of global technology companies. They're all over the United States and different countries. Their turnover is at 90%, which means if something doesn't work, they're moving things around and they're switching things out, trying to make stock picks work. And the thing that we love the most is that the minimal initial investment was $0. It was accessible and easy for all. Okay, so let's talk about the fund manager, Mr. D. Yao. He started working at Putnam in the IT department, and he is currently an analyst in Putnam Equity Research Group. He has 16 years in the industry, and his education is extensive. He's lived in various countries, and he has invested 100,000 to 500,000 of his own coins into this fund. So that was super duper important. And like one of our stock queens said, he is a scientist, he's a techie, and he's a businessman wrapped all into one, which probably explains why he's outperformed 93% of his competitors over the past 5 years by picking unknown stocks and big names in a way that no one understands, quoted by Business Insider. Oops. Okay, so let's just talk about the diversification. You see the United States has a big chunk at 56.6, and then the other countries below are big technology countries. The top 5 holdings have some companies that you probably are familiar with, 2 that you may not. Sino American Silicon Products is a company based in Taiwan. They were the first public and leading company specializing in manufacturing medium and small silicon wafers, the solar panels, since 1981. So that's 40 years in the game. Dynatrace uses artificial intelligence for big name clients such as Kroger, Samsung, and Experian. The competitive strength. So we've talked about Putnam Global Technology Fund, and they are under Putnam Investments. So the brand, it has a long established reputation. The fund manager knows these things through and through. And technology. They seek global companies that can benefit from changes, innovations, and disruptions. And we all know 2020 was one of the biggest disruptions of our lives. Mm-hmm. Key financial data. You can see the numbers went up, up, up. 2018, there was a huge drop. We couldn't really find the exact reason for that, but keep in mind that this is an international company. They have stocks all over. So international investment involves currency, economic, and political risk. probability for volatility is higher with a mutual fund that has stock picks from various countries. So it could have been any of those reasons or a combination of. But as you can see, 2019, we went higher and 2020 was even better. The ratios. So two things that I thought were important from this chart. The alpha shows the ability to beat the market, and a positive number of 1 means it's outperformed, and we're at 18.56. The beta, the S&P 500 index has a beta of 1. So this tool measures the volatility. If a stock moves less than the market, its beta is less than 1, and we're really close at 1.8. So the summary. Putnam Global Technology Fund is under Putnam Investments, which is a well-established company with experience and performance. We've got consistent growth with a long-standing fund manager and a 5-star rating from Morningstar. Here are a few resources that we use to get our information. And that concludes our presentation. Does anyone have any questions for us?
Yes, would you repeat your definition for alpha?
Absolutely. I have it. Let me make sure I'm not missing anything. So I said that the alpha shows the ability to beat the market. It's a tool used to show the ability to beat the market. And I just summarized to say a positive number, they go by, if it's a positive number of 1, then it means it's outperformed. And we were over 1 at 18.56, I believe.
Excellent, excellent. Cassandra, thank you so much.
Thank you.
I can tell that you guys did your work, and I absolutely, absolutely love it. The one question I had for you, in terms of your returns, I don't know if you guys paid attention to this or not, but did those returns include the sales charge or not?
The sales charge, I'm not sure.
Okay.
I have to look that up. This is a thing, and I'm not sure if this is a question overall. We tried to look at it up, and then I specifically tried to look up 2018. I saw a lot of my stocks that just we picked even before we picked a mutual fund. There was something that happened with technology. I don't know if it was technology specific, and I couldn't figure out what the rhyme or reason was for that in 2018.
Yeah, I do remember. I mean, I've got to go back and think now what happened in the market, but I do remember that there was something that did happen in the market to cause a bit of a dip. So in terms of returns, so you started off saying one of your first slides said that the fee or the sales charge to get in the load, right, was 5.75%, so 5 3/4.
Yes.
And so usually when they show returns, they show them both at NAV, which is what the price is, or they show it less the fee, so less the sales load. And I just was curious if your returns included that sales load or not. But that's something you guys can get back to us with.
I definitely will. I will check that out and make sure. Okay, let me make sure returns include the sales
load or the sales charge.
Load or sales charge.
Yeah.
I will research that and make sure I get that back to you.
Yeah, that was your front load fee on your first slide. You had it down there at the bottom. And I too, you guys did an excellent job. Great research. One thing that I would say is when you have such a big disparity, right, in the returns, one of the things that we learned last time is you can always pick up the phone and call their investment, the investment manager, or go back so that you can get your questions answered, so that you don't have to wait or just guess at what happened, because they are there to serve you and to provide you with that information. I'm sure they'd be happy to do so.
Okay. I'll also research that. Thank you.
Any other questions, ladies, before we go on to our next team? Okay.
Thank you for the feedback.
Absolutely. Which team would like to go next?
We would.
Okay, Simone.
Spellman Blue Checks. I'll let Robin go ahead and bring us up. Robin, you there?
I'm here. I am sharing my screen right now. Okay. There we go. Good evening, ladies. I want to present to you again the Spellman Blue Chicks, Talisha Bell, Tracy Bolin, Simone Corbin, Sally Joseph, and myself, Robin Stokes. And this evening we will present our mutual fund pick, and we're each going to take a topic. And so I will kick us off and talk about our methodology. Tracy will come and talk about the strategy and objective for the mutual fund that we selected. Then Talisha will come and talk about the holdings for that mutual fund, and Simone will wrap us up with the performance. So let's get started. We wanted to walk you all through just kind of our thought process in terms of how we selected the mutual fund that we landed on. So first, we did take a look at the overall list that was provided, and we wanted to also look at other options like aerial investments to see if that was something that would work for us. But we came to the conclusion that the minimum investment amount was more than we care to afford. So we looked for other opportunities. And so many of us use Fidelity as our platform, and Fidelity provides a way to search the mutual funds. There are over 3,400 mutual funds that they have, so they're not all Fidelity funds. Search through the mutual funds based on characteristics. So if you have an opportunity to go to the well and get the holy grail of mutual funds, then you're going to look for, you know, high return, low fee, low transaction costs. So that's what we did. But we originally found that that list produced a low amount of actual mutual funds for us to search through. So we relaxed a couple of those requirements and came up with a list of about 48 funds that we wanted to do further research on. After comparing them, we picked out a short list of 3, and you'll see those here presented on the screen. And so 2 of those use as a benchmark S&P 500, and 1 uses the Russell 2000 as a benchmark for that fund. So the difference between the first and the second, the equity disciplined and the Fidelity discipline and the Fidelity 500, you know, really the returns and everything were very similar. So between those, we kind of looked at the expense ratio, looked at those fees, and said, you know, between the two, the Fidelity 500 is better. Between the Russell Small Cap Index Fund and the Fidelity 500, which is what we ended up selecting, while the returns were very attractive, a couple of the other things that we took a look at was the longevity of the fund. So the Fidelity 500 has seen more cycles than the Fidelity Small Cap, and also took a look at what was actually the makeup, which Talisha will talk about a little bit later, but the makeup of the actual underlying stock investments. And there were names that were more recognizable to the team, and so that was a higher level of comfort. So that was our thought process in selecting the mutual fund. Now Tracy will come and talk and give some details about the fund itself.
Hello. We looked at the objective of the fund, and it seeks to provide investment results that correspond to the total return performance of common stocks publicly traded in the United States. And the strategy is they're normally investing at least 80% of the assets in common stocks included in the S&P 500 index, which broadly represents the performance of common stocks publicly traded in the United States. There is a company that manages the fund. So that is the fund manager, Geode Capital Management. And the current tenure of the manager is, they've been managing the fund since August 4th of 2003. Let's see. The investment approach is a diversified domestic large cap equity strategy that seeks to closely track the returns and characteristics of the S&P 500 index. The S&P 500 is a market capitalization weighted index designed to measure the performance of 500 large cap US companies. The fund holds each constituent security at approximately the same weight as the index. So we felt comfortable with this fund because it was following the 500 index, and we felt like as long as the stock market does well, then we'll do well.
Okay, the mutual fund holdings. The portfolio closely mirrors the S&P 500 with 100% domestic equities. It's a large blend fund with growth and value-oriented stocks. The companies all are greater than 10 billion. The companies are largely represented are informational tech companies. And as was mentioned earlier, we chose based upon a lot of name recognition for the companies, such as PayPal, Disney, Amazon, Apple, and Facebook.
Hi, everyone. I'm Simone, and I'm going to share with you just about the investment returns of Fidelity 500 Index. Basically, as Talisha has shared, a lot of the holdings under Fidelity 500 are pretty much very, very similar to the S&P 500. And that was important to us because we kind of feel like by going with Fidelity 500, we're actually investing in the S&P 500. So as long as the market is doing well, then we know that we're doing well. And in this chart, we've captured from the very beginning. Actually, I think it started in 2011. I just didn't include that particular bar chart, but we're comparing the Fidelity 500 Index Fund to the S&P 500, which is the benchmark. That's that is the benchmark of how well we find that Fidelity 500 is doing, because it does invest in 80% of the S&P 500. So it's pretty consistent with what you see there. And we felt like the returns, just looking at the chart there, the returns have been pretty strong year over year. We did have a few major drops that were due to some major market conditions. Even in the very beginning, when it started in 2012, well, actually it started in 2011, but in 2012, you can see we had returns of 16%. And again, that's consistent with the S&P 500. 2013, huge returns there, 32%. And I won't go through all the numbers, but I will just kind of highlight some of the years where we saw some major drops. In 2015, the returns were very low, 1.38%. And so when we went back and looked at historically what was going on in the market, that was during a time when there was some really volatile movement with the oil prices. So that had a really large impact on the market. Did someone say something? So the oil prices in 2015 had a major impact. And then in 2016, you can see the return was still fairly, it was okay, but it was still not quite as high as previous years. And that was the year of Brexit. And I think we can all remember that. And that impacted the market overall between the S&P. That really had a major impact. So that resulted in only a 12% return. Then in 2018, I know, Cassandra, you had spoke a little bit about the drop overall in the market. And based on my research, what I found there was a lot was going on in 2018, and it did affect the market quite a bit. That was during the Trump trade war that was going on. A lot was going on with the tariffs. There were taxes on the aluminum, if you recall that. I think the Feds had increased the interest rate during that time. And then it was also a pretty remarkable time. That was when Facebook, there was a lot of scrutiny with a lot of the social media. Remember when there was a lot of scrutiny with Facebook and a lot of things that were impacting the political climate, and they were, just a lot of scrutiny overall with Zuckerberg. I think he was you know, he was called to testify. And so that dramatically affected the market overall. And that's where a lot of the decline came from. And that was with Fidelity 500. And then I think you saw a lot of decline, Cassandra, in your mutual fund as well. So that's what happened in 2018. And then early in 2020, of course, we all know the COVID outbreak, that did result in the stocks declining in the very beginning, but then the stocks did end up rebounding toward fourth quarter at the end of the year, which resulted to the outcome of the election. There was quite a bit of research that was going on and some favorable clinical trials associated with the COVID clinical trials. So that helped rebound as well. And then, you know, there was also the approval of the stimulus package when Congress approved the COVID stimulus bill, that is. And so overall, even in 2020, with the outcome of COVID, we still ended up, I'm saying we, but Fidelity 500 as well as S&P 500, it still, you know, resulted in an overall return of 18%, which I thought was pretty solid considering how, you know, unpredictable everything was with the outcome of COVID. So that's kind of what the story is with the annual returns. So this next slide really talks about the diversity of the sectors. As you can see there, the different sectors. Information technology accounts for 27% of the overall fund with Fidelity 500, and then healthcare, consumer discretion, and a lot of the holdings, actually, yeah, a lot of the holdings Talisha had talked about early on are stocks that we recognize and we deal with and we buy from every day. Information technology, that's your Apple and Microsoft, Facebook. Healthcare, which made up 14%, Johnson & Johnson, United Healthcare, Pfizer, Abbott, and consumer discretion makes up quite a bit as well. Those are your Home Depot, Amazon, and I won't go through the entire list, but for the most part, if you look at the diversity across the sectors, we do see quite a bit of diversity. So we were real pleased with that. The asset class, it's 100% invested in domestic equities. And the investment style, they are large Berlin markets and the values of their stocks are greater than $10 billion. So these funds, they do invest in a combination of growth and value-oriented stocks. And 100% of the stocks obviously are in the United States. And again, this is consistent with the S&P 500. So we felt like the diversity was broad enough to give, it gives you exposure to the S&P 500. So if one sector doesn't do quite as well, for example, if real estate doesn't do quite as well or utilities, then you can still count on some of the higher market caps, such as information technology, to perform better over, you know, to perform better overall. And, you know, we just kind of felt like overall the fund can stand just a little bit of volatility because it's not investing in just one particular industry. So that's pretty much it as far as the diversity of our investment stocks. Does anyone have any questions?
Woo, 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 woo. Thank you guys. Simone, I'm so glad that you ended up using that slide that talked about 2018. I knew that there was stuff that happened, but I was waiting for someone to have actually looked into that. So I'm so glad. I was excited when I saw that you guys had actually pulled up what happened. And so, yeah, so that was really, really great. I know that you guys talked about expense ratios. Do you know if your fund actually has a front end load?
You know what? I remember writing that down. I remember looking into it, and I'm looking on the front page of Fidelity's. I know we don't have any. Remind me again, what is front load?
That is the fee that you would pay to get into that mutual fund.
No, well, we do know there is no, the fee is 0.015%. That's it. And
I
of
think
course,
that's
it's
just the overall
$0 to invest.
administration. Yeah, so that's really just the administrative fee. I think you're right. I don't think it has a load, so that was good. I just wanted to see if you by chance had caught that. So good. Yeah, that's a great performing mutual fund, and as you can see, you know, the blend of the large cap growth and the value, large cap value. You see a lot of these really big tech companies, which in 2020, technology outperformed everything, right? We were all home and we all needed technology, right? And so they all did very, very well. And so you'll find that. And then obviously healthcare being another one that performed very well last year. And then consumer discretionary. You talked about those companies, but consumer discretionary is, hey, where do we spend money? With, you know, where do we spend our leftover money that we have, right? And so that was another area that did well. And so, no, I can tell you guys did quite a bit of research. So I thought that was really, really great. And I'm excited about that.
Well done. Are there other questions before we move on to the other teams?
Well, this is Cassandra Bennett. I just wanted to say thank you, Simone, for that. And I also see in the chat, Areta also mentioned that about 2018. So that helped me to further my research, and I did recall some of those things. So thank you, ladies.
Excellent. Okay, team 3, who's stepping up to the plate?
Okay, well, we can go. True Blue Team Novices can go. Hi, everybody. Let me pull up my screen. My presentation, ours is going to be real easy because we too chose FXAIX. Let me pull up my screen here to my PowerPoint, my Google slide, I should say. I'm just also gonna put in our little rationale. I'm not gonna really repeat a lot of the fundamentals lest we repeat ourselves. So, but I'll start off. Let me go to slide format here, move this out the way. Goodness. What are y'all seeing this? Are y'all seeing my screen?
We can see it.
Okay, let me just there because Google Slide and PowerPoint are just. But anyway, so we are Kai Williams Slayton, Jennifer Redmond, Joanne Jackson Jones, and myself, Jean, as True Blue Novices, with our chosen fund, FXAIX. And Simone, y'all did a great job in summarizing things. So, in looking at coming off of, that's just more the fundamentals, and I know Simone did great, but in a recap of last year with, and I follow a lot of bloggers on Seeking Alpha that summed it up very well, you know, coming out of 2020 into 2021, and this Bill Grunderson looks at it as the year of transition we're in, whereas a handoff is happening from the 2020 darlings to them now becoming the what have you done for me lately, a Zoom, Teladoc, Peloton, Amazon, and here we are in 2021, and the great reopening or the flavor of the days, energy, industrials, and financials. So in a transition year such as this we're in, I can think of no better fund that kind of captures the essence of all of these, as so the large caps of these anyway, that captures the essence of the blend, such as Jennifer just said, the blending of the large cap growth and the large cap value. You get tailwinds with either way, and you're keeping your beta really low to sleep well at night, to ride out the year. And so we had compared, we actually had top two. FXAIX was a contention, and there's a chart. It's a nice visual that kind of shows you the trajectory. The little small numbers, that's 2020 on up to the present. We compared it to the next top one we were considering, HCAIX, which is Harbor Capital Appreciation Fund. And that's that chart. Now, Harbor is more growth. So more growth. And so we as novices, which our name implies, True Blue Novices, you know, we can, you know, feel good to use a year such as now, with it being choppy, to understand what we own and why we own it. And with the large caps that are household names, such as in FXAIX, I mean, we can easily do that. And I think another year when we can feel more comfortable about learning about growth and funds that represent growth, we will be better able to embrace it and understand when it is choppy and why it's choppy. To stomach that the roller coaster growth stocks can put you in. So this to me is a great entryway to a fund that's relatively sleeping well at night, and a low beta and a low expense ratio, which Simone's group pretty much flushed that out. So yeah, so that's our presentation.
Awesome, awesome. Let me ask you, I know the other two groups started, and thank you so much for that.
Oh, did anyone of my group want to chime in? I'm sorry. Any of the others?
No, this is Kai. You did a wonderful job, Jean.
Oh.
It really came down to expenses for me. That's why my vote was for the other one.
Yes. Thanks, Jane. Awesome.
What was y'all's methodology for choosing the two funds that you all ended up with? I'm just curious. Out of, I don't know, over 7,000 mutual funds that there are, how did you guys end up with those two? Like, what was the process you all went through?
We took your list and we split it up amongst ourselves. A lot of us, I wasn't one to research outside of your list, so we basically all took the list and then we each picked one to pitch to the team in one meeting. And when we came down to the pitch, we then got down to those two. And then we everybody had time to digest it. The two people who picked those two funds then kind of wrote a further analysis, and then we voted. And that's kind of how we did. That's how we came down to those two funds. Jean has a little more experience, so she had put some funds in there that weren't on your list. So it was, it was helpful, but I think a lot of us, the remainder of us, kind of just use your list.
Great, great.
So Spelman minds think alike. Is that what you're saying, Jen?
Yeah.
You have two teams that have the same pick. That's great. So who would like to go next? Which team?
Hi, the Legacy Builders would like to go next.
Great.
One moment, please. I'm going to share my screen and myself. Sorry, one moment, everyone. Good evening. My name is Julynn Williams Chandler. I'm this evening's presenter for our Legacy Builders group. I am joined by our group member, Mrs. Iretta Kearse, Ms. C. Suzette Taylor, and Ms. Quaylee Carson. And we will go ahead and proceed. Just starting out with the way we began our process of selecting our mutual fund, it was definitely a serious undertaking because there were so many, but we began with searching the list that was provided and filtering, dividing it up by group members. So each of us, I would say, had roughly 5 to 6 funds to actually research. And then we reconvened at our next meeting and decided which funds to present based on our findings. And just so you all have an idea of the criterion that we used, we were highly invested in looking at funds based on minimum investment price, so the current price of the particular fund. We also honed in on the Morningstar ratings, Morningstar risk rating, We also looked at the beta and a 5-year return. We did glance at that, the inception date as well, and then the average tenure of the fund's managers, as well as the historic risk and return process for our funds that we all grouped together and did our research on. As a group, we focused in on those specific areas that I mentioned earlier. However, there were some that we still considered important but didn't focus in on as much. And that was the benchmark, the net assets, the year-to-date return, expense ratio, 1 and 3 year returns, as well as the dividend ratings, the dividend data, and whether or not our fund was managed or passive. And ultimately, it came down to not really mattering as much because it looked like all the funds that we chose were managed. So that made it a lot easier to I guess, zoom in on the ones that we felt were the best fit for our group. One thing I did want to point out, though, is that our current Morningstar rating, we wanted to make sure that we stay within a certain frame of 4 to 5 rating. And of course, our beta, we wanted to be as close to 1 as possible. And with our 5-year return, we didn't want to do overstretch because we are new to this and we weren't entirely sure what to look for. We did know that we wanted to at least see some positive growth in our funds over a 5-year period. So that really, really helped us to narrow things down a bit. And let me just move this out of the way from my screen, ladies. Right here, you'll see that these were the funds that we broke up and we split up amongst our team members. And it's color coded for a reason because each of us was aligned with a color. And that particular color meant you did the research on this fund and I did it, and so on and so forth. Our legend at the bottom will tell you that the ones here on the left that are grayed out are the ones that we actually decided on. So each of us took one and then we came back to the drawing board after doing our individual research and decided that these were the ones that we would collectively decide upon. Are we going to move forward or not? And as you can see, and Jennifer, I'm so glad that you brought it up about that little tidbit about mutual funds and knowing your minimum investment, because that really helped us to make our final decision about what we were going to do. So as you can see, we chose, and I'm sorry, ladies, we came up with our own little jargon for these. So PFANCS, which is PIMCO, and PG Tax for Putnam. And those are the two that we decided to actually move forward with. And I'll give you a little bit more information about why. So in addition to there being just a lot of information that was coming at us at one time, we wanted to make sure that we were choosing what was right for everyone. And after looking into the minimum investments, we quickly made a decision to not only split up our funds that we were investing, the $100 that we had all agreed upon. We said it would be a really good idea to just put our money in different areas just to make sure that we were covering our bases. And initially we were going with Vanguard and what we will refer to as WICS, which is the Social Choice Low Carbon Equity Fund. But that $2 million, it was sobering, and as well as the $3,000 for Vanguard. Now, these were really popular for us, names that we had heard before, which is why Vanguard stood out. We were like, oh yeah, let's do Vanguard. We're familiar with it, but we really didn't know all the ins and outs and what it would take. So I'm so glad that we have this information now and we can move forward with making the right choice, not just based on popularity. So that really, really helped out a lot. And just moving forward, with some of the information that we looked into, which had a lot to do with our holdings. So company holdings definitely showed why it was that we wanted to move forward. But prior to getting into that, I'll explain about our beta. And as you can see here, with PG Tax being one of the choices that we made, their cost was $63.48 for purchase. But their beta was a 1.08, which stuck out to us. All of the 5 funds that we selected initially had a really nice beta according to what we thought was favorable. But all things considered, PG Tax definitely stuck out to us as one to go by. And when it came to PFANCS, as you can see, their beta was 0.74, which we thought was awesome. I mean, in comparison to others, we really felt like, okay, this is a really good choice for us to move forward with. And then when looking at the ratings and the risk information, we found that both of them had average ratings. So that stuck out to us, and we felt like this would be a really good way to move forward, because not only were we comfortable, we didn't feel like we had to do too much digging to find the information. Being that some of the inception dates were a little earlier versus later, we wanted to make sure that we were making a right choice with the companies that had some longevity. And back to the holdings for the companies, I will say that we were really impressed with the variation of companies that we saw. When it came to capital securities, I felt like each and every one of our group members felt like she aligned with one of these groups or one of these companies. We were all familiar with the names, nothing that seemed odd or out of place. So we felt really, really comfortable with choosing this fund specifically because everyone knows Bank of America, Wells Fargo, JP Morgan, and we felt like, oh, if they're going with it, then we can go with it too. And when it came to PG Tax and their investments in global tech, oh, we were on board with it. PayPal has been ringing our ears for a really long time now. And once we said, like, oh yeah, PayPal it is. And then of course, Microsoft being one of the very top holdings for this company, for this fund, we were on board with it. We wanted to move forward and make sure that we initially wanted to invest with a company that was associated with Microsoft. And I'll be honest with you that each of us felt like anything that was related to tech at this point in time was something that we could actually align ourselves with. Moving forward to just a little bit more of one of our, we talked about the beta. But when we started thinking about management and going back to who was actually in charge and who had a handle on what was going on with these funds, we were looking at longevity, and the average tenure for Putnam's company, that one manager has an average of 8.3 years. Now, whether or not someone has been cycling through, it didn't matter, but as you can see, Mr. Yao has been there for quite some time, and that really made us feel comfortable as if he was a knowledgeable individual, he would know what to do moving forward, and we wouldn't have to see so much fluctuation in the funds that were switched out over time. And when it came to PFANGs, I mean, 5.9 years isn't that bad at all, and according to research, Mr. Botero, he had decades of experience in the industry. So that really, really sat well with us, knowing that we could possibly trust. I mean, we don't know these people personally, but it seems like over time, they have made some really good investments and really good decisions about how to manage the fund. Moving right along, sustainability. Now, we talked about this when we were going through the stocks portion of our research. And it came up in conversation with my group members and I that we wanted to make sure that we were investing in funds that aligned with what we felt were important things and important aspects of society, global, environmental, social, governance, like who's investing in what political parties and which, just which things are important to you as an individual. And, based on the sustainability ratings, we were all comfortable with making the decisions. As you all can see here, there was a 4 sustainability rating, and that was for PG Tax, and for PFANGs, they have a level 3 sustainability rating. So as long as we didn't see any 1s, we felt pretty solid about moving forward with our choices. And here's the information for PFANGs, just to give you a glimpse. And before I move into the summary, just wanted to let you all know that we used both Morningstar and Yahoo Finance for our information. It helps to have, a spread. And overall, we want to make sure that we are pulling information from various tools as opposed to relying on just one thing to get the information from. And I think it really helps to have everyone looking for the information, because sometimes one person might have more insight as opposed to another, and that's okay. But we learned that about ourselves as a group, that it helps to have everyone kind of talking about what we're learning and being able to share that information as time goes on. So in summary, we found that our ability to split our investment across multiple funds, well, 2 funds in this case, It would really, really help to diversify our portfolio of assets as we move forward. We're going to continue to go back to the drawing board and look at some of the things that we may need to add on. And one thing I know for sure that we will be paying attention to going forward is our minimum investment. That's one criterion that we would like to add to our list, as well as keeping up with the ESG and also looking at the alpha, because that did come up in conversation later on, but we didn't invest as much energy into that part of our process. So we definitely will be going back to revisit. And as far as competitive mutual funds that one day we hope to invest in, of course, Vanguard and Wix, and of course, Loomis was one of the high ones on our list. So we do want to go back to visit that at some point when we become millionaires. An interesting fact is that some of the funds seem to be targeting a particular type of investor. And, you know, I guess as time goes on, we'll learn more about that type of investor, but I do want to make sure that we have an understanding of what they're looking for and how we can meet them where they are in order to make the best possible investments. And just for everyone's, you know, sake of having knowledge, key factors for evaluating mutual funds, you know, just think about who's running the fund, what kind of person they are on paper, of course, matters. And then in society, if you hear any scandals about this individual, are they making poor, you know, judgment calls in their own personal funds and their own personal investments? That does matter. How has the fund performed over time? Because, you know, when it's a newer fund, we want to make sure that over time we're seeing growth and we're seeing a lot of productivity. And then how well do your investments work together? That's really important to us as well. Are things in alignment? Are there any crossover? And just what can we do as individuals to make sure we're making the best possible decisions? So thank you all for your time. And we really, really appreciate you for listening to our presentation. Go Team Legacy Builders.
You did that, Jolie!
Thank you all.
Great job, Julin.
Thank you. Thank you.
That was really great. That's so funny, Julin, because I was like, okay, which one did they pick? Which one did they pick? So you guys ended up making an investment in both, huh?
Yes, ma'am. Mm-hmm.
And that's really, really interesting, because one of the questions I had initially was, okay, so are they growth oriented? Are they, because one of the things that I think about and what we've seen really from the other teams was they're interested in capital appreciation, they're interested in growth. And so you guys completely went growth and income, okay? So you did bring that diversification, which to me would put you guys at like a moderate investor, more of a balanced investor, right?
Yes.
So it's really good to see, because you brought sort of something different to what we've seen so far. And that was really, really good. So that was my biggest comment was, okay, which way are we going? And the fact that you, employed really some additional diversification into your strategy, right? Mutual funds bring a ton of diversification, which is why they're a great investment. But you guys, did a little bit more. So I love that.
Thank you. And I will say that when we actually started having conversations with one another, trying to figure out what type of investors, we all did meet in the middle and say, I'm kind of like on the fence. We're not dipping our toes in. We're kind of like putting a whole foot in, but not the leg. So, we're hoping to one day it'll pay off. So we're not just going to go out and start selling our stock and funds. Thank you.
Awesome.
Great job.
And then I think we just have one team left, right?
Yes, blessed by beyond measure.
That would be us. This is Patrice.
Hey, Patrice.
And I am going to share my screen. Give me 1 second. So we are Blessed Beyond Measure, and our group is Darlene Garcia, Karen Wood, Kimberly Murray, Pamela Cooper, myself, Rhonda Hudson, and Crystal Woods. And we have gone through, each of us were assigned a number of funds to investigate, and we met together and presented what our investigation results were. So we're only presenting the final choice for the team. Now, we'll talk about a couple of our top two. So our top two were BlackRock, Health Sciences, and we finalized our decision on Loomis Sales, High Income Opportunities Fund. We chose this one primarily due to cost. And we wanted something we thought we could get in on the bottom level with, trying to save money, but look at something that had pretty high and consistent growth. They've had long-term managers. They've been able to identify multiple locations that we're familiar with. Everything on this high income opportunity fund has a familiarity with it. So within the fund, you've got Uber, you've also got Boeing. Now, neither of those are doing their best right now, but because of the dynamic shift of those two, you're able to have consistency overall, and that is what is presented there. The snapshot says that they have 276.97 million available in this fund, and year to date, the return is 0.058. Because of the way it's set up, Morningstar has rated it as a 5-star. So we found that it would be very interesting to consider this. Performance overview, year-to-date return is 4.58%. 5-year return on average is 5.39%. And the best 1-year total return has been February of 2019, where it actually went up 60.32%. So, of course, the same date, it shows that it went down -28. So we were debating on what that really meant, and most of us thought there must have been a drop before it increased unexpectedly. And that's what occurred on February 3rd, 2019. It has been consistently up. Overall, it's had 13 years of good performance and only 3 years of poor performance. We are finding that, of course, we're not the $1 million babies quite yet, but we wanted to look at some of the areas where it would be weighted, and that is listed here. We've had a lot of talking, so I'm just letting everyone know that this one is considered to be a 3-star risk by Morningstar, and we are looking at the minimum initial investment as 0. Now, we've gotten conflicting information, and Jennifer, this is a question we have for you. We have one location that says there's a 0 minimum investment. We have another location that says there's a $100,000 minimum investment. How do we identify which is really the case?
The only answer that I have is that maybe it depends on what trading platform you're using. And so based on whatever relationship that trading platform has, that it has a retail, it's a retail trading platform, which means it's great for retail investors. That usually will be something under $1,000 minimum investment to get in. So that's the only thing I can think of. Adrian, would there be any other explanation that you can think of?
Not that I can think of.
So that's sort of where we were going with it, but we didn't have.
Or it may also, the other thing, I'm sorry, Patrice, is maybe, did you guys pull up the same class? Because mutual funds, you can invest in them based on different classes. Usually the class A share has a front load. The class C, so maybe one of you all pulled up one class,
okay,
versus another, and some classes have a higher minimum.
Got it. Okay, that makes sense. So we also wanted to let you know our second choice, which was BlackRock Health Sciences, and part of the reason why BlackRock was of interest to us was because we saw that it had a front load of 5.25. That was number one, but number two, it has been consistently moving up over the 10-year platform. It has a 4-star rating, but overall it's been a high performing fund. So BlackRock is an unknown, well-known entity, and Morningstar had it rated in such a way that it caught our eye. They have a lot more in their actual asset category. So instead of the high millions, they're in the low billions. And overall, it's had a 24% consistent return since February, but its cost is 74.10 instead of the 10 that we found on the one that we were looking at. So of course we selected it based on price, but we really wanted to also get some familiarity. And the other stock that we found really had, the other fund had the stronger recognition level. And that's it. And this is Blessed Beyond Measure. Thank you.
Thank you, Patrice. Okay, so you guys ended up going with the Loomis Sales High Income Fund?
Correct, yes.
And that was basically based on price?
Primarily based on price and amount of required initial investment, yes.
Okay, what do you know what the, I'm sorry, what was the minimum investment for the BlackRock?
BlackRock was 74, $1,000, I'm sorry. It was $1,000.
Oh, it was $1,000
yes.
minimum. Okay,
yes.
Yeah, okay.
And we found that on multiple platforms. So the 1,000 minimum for BlackRock was on multiple platforms. The 100,000 versus the 0 on Loomis was on different platforms. So that was our analysis. Thanks, ladies.
Thank you.
Jennifer, can you
comments by any team members?
Beth, did you have a question?
I was, once you conclude with that team, I did have a question for Jennifer.
Go ahead.
If you can talk a little bit more about the different classes. I have seen that, and obviously since they have different prices associated, I'm assuming that you get different benefits based upon the classes, but I don't know that I quite understand how that's developed, and what should your strategy be when you go to purchase? Are you looking for the premium class, or are you okay with the not so premium class, and kind of what the differences are? I wonder if you can just elaborate a little.
Sure, and that's a great question. That's a great question. So the classes normally go 1 to a minimum investment, right? Class A shares tend to be where most retail investors come in if they're working maybe with an advisor, right? Or they're using a platform where there is a front-end sales, a front load. So it was interesting. I think, Patrice, you mentioned that the BlackRock was attractive because of the load. The load is not a guarantee for what they're going to pay you. The load is actually the charge that you pay. It's a fee that you pay to get into that mutual fund, okay? Upfront, that's an upfront fee. So 5.75% means that for every $100 you invest, $5.75 comes off the top, right? And what you invest is, $94.25. Okay, out of that $100 that goes in. So that's what that front end load means. Some shares, like a C share, you can come in without that front end load, but it's more for a short-term investment, right? Because then the fees tend to get a little bit higher, just depending on, what time period you're holding that investment. And then some of the other shares just have a much bigger minimum investment for you to get in, right? So it just depends. But that was a great question. That was a really great question.
Thank you. I did also notice, and I'm sure many of the others noticed too, in the fine print on some of the front loads, depending on the more money that you invest, the front load goes down. So like for our Putnam Global Technology Fund, it starts at 5.75 up to $50,000. But if you're investing more, that front load percentage rate goes down.
That's right. It's called a break point. And so you have them at different investment levels. So that was a great observation. You're absolutely right. That front end load does go down, you know, if, you know, you go from 50,000 to 100,000, if you're investing, you know, 250,000. So that was a great observation, Beth.
That's great.
Yeah.
Well, ladies, again, you all have done a phenomenal job in your presentations. And so we are going to transition now to our presenters for this evening so that we can begin to prepare for what we will do our research on next month. And those are REITs, for real estate investment trusts. So I mentioned before that we have our representatives from Bank of America presenting with us this evening. Tiffany Eubank Saunders has been with us for our Wealth Building Wednesday series. So she is back again today as a market executive. And she's also accompanied by Mary Stokes. And Mary is also a marketing executive with Bank of America. Mary's resume, you know, we've met Tiffany and Mary. I was impressed with so many of the things that you had included on your bio, primarily that you're in our marketplace, you're in our backyard in Atlanta, but it was also impressive to see the breadth of your experience for the advisory boards in which you serve on. So I know that that probably helps you bring a very unique perspective. And so with that, I'm going to turn it over to you two ladies to go ahead and do your presentation, and then we will have Q&A after that.
Welcome.
Perfect. Perfect. Thank you, Adrienne. And good evening, ladies. I tell you, it just warms my heart to see Black women doing their thing with investments. It is this is a space that we have not traditionally been taught about. And quite candidly, it's a discipline that can be intimidating. And so I'm so thrilled to see that you all are taking on the courage to really learn about what really can be the keys to the kingdom, so to speak, as it relates to creating, not only creating wealth, but creating generational wealth so that you can leave a legacy behind you. And what I would just encourage you all to do is everything you're learning here with Jennifer and Adrienne and the wonderful experts they're bringing to the table, please, please, please share it with your family, your friends. Let's create a community of education and awareness. Let's keep building the knowledge in the Black community as we move forward so that it becomes less intimidating and more of our regular practice and behavior within our community. And as Adrienne mentioned, we've got Mary Stokes here with us today, who is one of our market investment executives. She sits in your very own backyard, as Adrienne mentioned, in Atlanta, and probably is one of our Mary is probably our most seasoned Black female investment executive within our private bank. And I would venture to say, Mary, I'm not sure, you can tell me, but probably within GWIM in general. She's been doing this for quite some time, manages a large team of institutional portfolio managers, and really just, when Adrienne asked for someone to come and speak about REITs, Mary was clearly top of mind, and I know she's been working with her team to pull together some good information just as a foundational base. So Adrienne, I don't know, I sent you the deck earlier. Were you able to access that?
Yes, give me one
Perfect.
second.
And you all, while we're waiting, you all did a phenomenal job with your presentations, by the way. I tell you, when Adrienne told me how long this investment program or club, if you will, had been going, you certainly are leaning in and learning all of the good information and putting it to practice. And it's pretty impressive to see how you ladies have committed to meeting with one another and really researching the options that are out there and following the science of investing. Science and art of investing. I should say. All right, Mary, I'm going to turn it over to you.
Wonderful. Thank you, Tiffany. Can everyone hear me okay this evening?
Yes.
Okay, wonderful. Good evening, everyone. I will second what Tiffany said. I was sitting here listening to the presentations and I thought, wow, they're pretty good, right? You guys have learned a tremendous amount of knowledge and information over the time that you've been in this investment club. And so one of the last pages I'll have in this presentation is around, how do you research a manager? And I kept it very general, right? And didn't drill down to the REIT asset class, but we'll go through some of the things to look at when you're actually evaluating a REIT. But I think you guys have a very good foundational knowledge. And so one of the things that Tiffany mentioned is, I am in your own backyard. I manage actually a team that manages money for foundations, endowments, and pension plans, right? So we term that institutional investments. And so I've been doing that for over 25 years, both at the bank and at competitors. So this is an area that I really have a passion for. My husband tells me from time to time, he said, you're the only person I know that gets up in the morning, you're happy to go to work, because I'm so passionate around this area. And so with that, if you could turn to the second page, Adrian. So what is a REIT? Think of a REIT as really a basket of commercial real estate property. And it's a company that owns this basket of real estate property that's income producing. And so REITs are required to derive at least 75% of their income from real estate. And in order for them to be classified as a REIT, they have to pay out 90% of their taxable net income to investors in the form of dividends. And the reason why that may be attractive, REITs may be attractive as an asset class, is a lot of people are looking at dividend investments, right? So it's not just the growth or the capital appreciation in the stock, but it's also the dividends that you're getting paid off that stock. And so REITs tend to be a higher dividend paying asset class. And so we can turn to the next page. And so it's owning, so REITs really follow an active, hands-on, owner type operating model. So it's owning a collection of assets, which was common really in the early years, but collecting rents continues to be the real main source of revenues for REITs. And so it's not only that income rent generating source, but it's also that capital appreciation when those properties appreciate in value. So REITs grow internally through the income that they get from occupancy rates and rent increases anytime there's a tenant upgrade to space or redevelopment of that property. But they also can grow through external acquisition, so buying additional commercial property. And so I would venture to guess that many of you, when you meet next month, will be doing a lot of research on equity REITs. And the reason why I say that is because equity REITs are the predominant REITs in the market, right? And so they're an entity that really owns and operates this income producing asset, such as, so think of apartment buildings, office buildings, warehouses, regional malls and hotels, right? So they generate the majority of their income from that rent. The second type of REIT is a mortgage REIT, and they don't own the property, but what they do is they lend to the owner of the real estate property. And so they're the ones that hold the mortgages. And so they generate the majority of their income from interest. So where the last stats that I saw, equity REITs make up about 83% of the REITs in the market. Mortgage REITs make up around 17%. And then this hybrid REITs, they really don't report on it anymore, but it's a hybrid between both the equity REIT and a mortgage REIT. And so it's an organization that not only owns the property and gets their income, right, from the leases and the rents, but also organization that lends to those properties, right, in the form of loans, and then gets interest income from that. And so when you start to do your research around REITs, you're going to find that if you're going to a retail type platform, that they're going to be publicly traded, right? So these are the REITs that you can pick up the Wall Street Journal, right, and look up the name and look at the ticker symbol, right? And it's very easy to get it on any platform. So whether it be Fidelity, Merrill Lynch, Charles Schwab, Vanguard, right? They're going to be listed there. Non-exchange traded REITs are not registered, or they are registered with the SEC, but they're not available on exchange. So it's not something that you're going to have readily access to. And then the private REITs are unlisted, right? So it makes it very difficult to value and to trade. So you're not going to see these in the Wall Street Journal, right? They're generally exempt from SEC registration. So if you could think of this on a liquidity, so something that's very liquid to something that's very illiquid continuum. So the publicly traded REITs are very liquid, right? They're bought and sold daily on the major exchanges. Non-exchange traded REITs are illiquid, and then private REITs are probably the most illiquid. And what I mean by illiquid, not only are you not going to see them in the Wall Street Journal, but they typically have rules around redemptions, meaning that redemptions typically don't happen either quarterly or semi-annually or sometimes even annually. And so typically when I see private REITs, because they're so illiquid, because information is not readily available, those REITs are generally only available to what we call accredited investor. So the publicly traded REITs, you and I can go through our brokerage platforms and buy and sell them all day long. The private REITs, by contrast, accredited investor means that you have to have over $1 million in net worth, right? And that's excluding your primary residence. And there's an income requirement. So if you're single and individual, then you have to have an income requirement of at least $200,000 a year. If you're a married couple, then you have to have an income requirement of at least $300,000 a year. And so that's why we don't, that's why they have those rules in place for private REITs, because they intend the investor to be a little bit more sophisticated because the information is not readily available. Okay, if we could turn to the next slide. Okay, so when I think about REITs, and one of the reasons why it's attractive for the average investor is because it has characteristics of both bonds and equities. So the long-term nature of the REIT leases, that income is really like a bond, like the interest income you would get off a bond. Because it has the ability to appreciate and value, the properties have the ability to appreciate and value. That's the equity-like, right? So you get the growth or the capital appreciation. If we go and look at the chart further down the page, what I have here is a comparison of 3 different benchmarks. And so when we're talking about public REITs, the main benchmark that you would use to evaluate, right, the performance of a public REIT would be the NAREIT. Huge, they've been around for a long time, publicly available information. And so you can see here that I've shown information from year 1 through 20 years. I've shown the current yield and I've shown the volatility. I compared those statistics to the S&P 500 and the Bloomberg's Barclays Capital Aggregate, which you can think of that as like a core bond type index. And so the way to think about REITs is they typically have return characteristics that are in between equity, so in between the S&P 500 and the core bond index. And so if you look longer term, for example, let's look at 15 years. Over a 15-year time horizon, this is as of December of 2020, the S&P 500 has returned on an annualized basis almost 9.9%. A core bond index has returned about nearly 4.5%. And then the NAREIT is a 6.5%. So that's what I mean about the return being in between kind of the equities and the bonds. You heard me mention earlier that one of the reasons why yields are attractive or REITs are attractive is because of the yield. And so you can see here long term, the yield on REITs, particularly in this market environment, right, when rates are so low, is attractive. So the current yield on the NAREIT, for example, is about 3.5% versus 1.8 if you would look at a core bond index, and about almost 1.6 for the S&P 500. So that makes REITs a little more attractive. Volatility, though, for REITs is similar to the S&P 500 for publicly traded REITs because they really are more equity-like because they can be bought and sold on a daily basis. Private REITs, however, the standard deviation is probably less than half that because there's not a lot of turnover when you look at commercial real estate. So any questions on this page, just to kind of put the performance and the risk characteristics in context?
Can you give a little more information about how you read that standard deviation? How do you know when it's good or bad? I'm not sure that I'm interpreting exactly how you are determining whether it's good or bad for a particular REIT.
Yeah, so, and that's a good question, right? Because the number by itself doesn't necessarily mean anything, right? It just means that that particular index that you would typically measure that REIT against has a volatility of 17.8. And by the way, a volatility of 17.8 is kind of high. It's like the S&P 500. How I would look at this and evaluate that statistic, right, would be if I were looking at a REIT manager, and let's say their return numbers are very good, right? But let's say, and I'm just picking a number here out of the air, let's say their standard deviation or their volatility is 25. Then I look at that and I say, okay, their return history is good, right? It's in line with the benchmark or even a little better than the benchmark, but they're a lot higher than the benchmark. So do I really want to risk or be invested with a manager that has a lot higher volatility, right, than even the index? But I'm not getting compensated for that additional volatility in the way of higher returns. So that the volatility in and of itself, right, you would expect it to be high for a REIT because it trades like a stock, but I would put it in context of the actual manager that you're evaluating. The other thing that I would point out on this slide and I would say don't get alarmed by, because if we were looking at a different point in time, the numbers would be very different. And so you see the 1 year is a negative 8%. I wouldn't be alarmed by that because we've just come through a pandemic. And so when you think about a pandemic and the impact on real estate, there's some winners and losers. It's really a bifurcated real estate market right now. And so one of the winners, if you will, would be warehouses. So think of the industrial type space, right, where there's been a great need just because they've had to produce more PPE. You think of Amazon right now, and it's really exploding, right, and needing more space. So those are some of the companies that have benefited from this type of pandemic environment. On the flip side of that, though, you have hotels. And so occupancy rates in hotels were very low. So that impacted that sector of the real estate market. You have office buildings, and office buildings right now is a question mark. Because of the pandemic, how are corporations going to respond in terms of the amount of space, office space that they'll need going forward? And so that negative 8% return for the most recent period is because of the pandemic. Had it not been for the pandemic, the numbers would not have looked like that. And we do anticipate that certain sectors of the real estate market will come back. So we do believe that once leisure travel, business travel picks back up, the hotel sector of that market will come back. The apartment building market has been pretty resilient throughout this, right? Because people have been in their apartments, assuming that they were still employed.
Hey, Mary. I'm
Yes.
sorry, somebody was going to say something?
Yeah, I was
Right.
just going to ask another question. My understanding always was that the reason why you would invest in bonds or that type of security would be to diversify your portfolio. So if one thing was up, and I mean, if one thing was down, the other was up. So I'm just trying to understand for REITs, is that kind of where question one, is that where it fits in? Is that it's something to diversify? And then number two, I guess, would be how does it track to like the S&P 500? Because I'm seeing the returns and clearly they're much lower than S&P. So is that to say when stocks are down that REITs would be considered to be up? Or, you know, what would be the benefit of investing in a REIT if it was following or tracking to the S&P 500? I hope that makes sense.
It does. It does. And so when we look at REITs, it's a diversification, right? It's to further diversify your portfolio. So let's say you already had an equity type mutual fund, you already had a bond type mutual fund, right? REITs really are a further diversifier. And the reason why that provides additional diversification is because the correlation of real estate in general, right, is not like the stock market and it's not like the bond market, which means if the stock market, for example, is going up, you wouldn't expect REITs to do as well, right? Doesn't mean they'll necessarily be negative, which is what we see on this page because of the pandemic, but they won't do as well. Where REITs really, I think, add value is when there's a downdraft or an air pocket, what I call an air pocket in the market, which means equities are going down, right? REITs have that floor, if you will, because they have that income component. And so if you were to model how REITs behave in a client's portfolio, they really provide downside protection when there's a lot of volatility in the market. And so I wouldn't look at this page as, you know, I should invest in the S&P 500 versus the REITs, because I don't expect the REITs to behave like the S&P 500 or to behave like bonds. It's a separate asset class, right, that has attractive properties. And one of those properties is that downside protection.
So Mary, can you help us get a little bit more clarification on the terminology that we're using between REITs and our stocks? So for instance, as we look at the regular return over 20 years versus the current yield, should I be looking at those two together to evaluate my overall return? Or should I be paying attention to more on the return side than the current yield?
I would say both, right? And I say both is you're going to want to look at that return, and you're going to want to look at specifically at the return of the manager versus the benchmark, right? So every manager has a benchmark. You want to make sure they're using the appropriate benchmark, right? So you shouldn't see a REIT manager using the S&P 500 because that's not their sandbox that they should be playing in. But this NAREIT that I show on this page is an appropriate benchmark for a publicly traded REIT. And so you should look at the return, make sure the manager is able to at least, right, perform in line with the benchmark. And if they have not, really try and understand why. Because one of the attractive properties of REITs are the yield component. So you get that income component too, right, from the leases. I think the yield is also important to take a look at when you're looking at a REIT manager. So you can't compare the yield of a REIT manager to the yield of the S&P 500 or the yield of the core bond portfolio. You really should be comparing it to the benchmark itself, because it really is a different asset class. Okay, if we could turn to the next slide, if there are no additional questions. So what does the REIT market look like right now? And so this slide is a breakdown of the types of properties that make up that NAREIT benchmark that I just talked about. And so if you were to look at, which ones make up the bulk, right, or a larger percentage of that NAREIT, it would be office buildings, it would be industrial buildings, and it would be healthcare. Apartments are here as well. So that gives you a sense of how the market is kind of sliced and diced as it relates to real estate. And that's important to know because when you evaluate a real estate manager, you're going to want to make sure, just like you have for the other mutual funds that you talked about earlier this evening, you're going to want to make sure that that REIT manager is diversified. So you don't want to see a REIT manager, particularly if this is your first, right, REIT fund. You don't want to see a manager that maybe has all of their properties in office or all of their properties in regional malls, right? So you diversify the property so that you diversify the risk. Okay, next slide. So why invest in REITs? You heard me, you saw on the earlier page that it's a negative return right now because of the pandemic. But typically long-term, there are attractive returns, right, for that asset class. You do have the opportunity to earn dividends off of that investment. And there are other asset classes where you don't get as attractive as a dividend return. You heard me talk about low correlation to other assets. That just means maybe when the stock market is doing very, very well, the REIT market is not doing quite as well, and vice versa. And that's what you want, right? You want asset classes that don't move in the same direction by the same degree. That's what provides the diversification. And then typically is a more moderate volatility. Okay, so this is where I thought everyone on this call did a really nice job this evening, right? And that is, how do you research REITs? And so as you were making your presentations, I really listened for some of the things that are noted on this page. And so I put this page in because this is the page that we use to explain our process internally at Bank of America, regardless of whether or not we're evaluating a mutual fund or whether or not we're evaluating a separately managed account or some other vehicle. And so one of the first things that we look at is the firm. So how long has the organization been in business? Who owns the organization? What's the ownership like? Is it stable? What is the breadth of products? And so this is important because when you're looking at REITs, right, you want to invest with the firm that really kind of knows what they're doing, right? They invest in REITs. They know it very well. They have a long track record, right? And if you look at the breadth of their products, it's not the only product that they have. We also look at the client base. Is it more retail? Is it more institutional? And any ownership changes. Has it been steady ownership over the years, or have there been changes in ownership? And the reason why that's important is because you're investing with a manager that has had a lot of ownership changes, right? Their philosophy can change over time, which can impact performance. And then, are they growing? Is it a growing firm? We also look at resources. So people, who's managing the money? And I heard this come out in the presentations this evening. Is it someone that has a lot of experience in the investment world? Have they been managing this type, right, of asset class for a period of time? Is their compensation aligned with the success of the fund, right? So do they really get paid when the fund does well, which is what you want? And what's the history of that product? So hopefully it's been a product that's been with the firm and been managed for a long period of time. And then methodology is, what's the philosophy? You want to make sure the philosophy hasn't changed over time. You want to make sure that their risk return characteristics over time historically have been consistent. There haven't been any big blips either to the upside or to the downside. And then you want to make sure that they've added value over the years. And then lastly, it's the proof is in the pudding, right? How have they performed? And so one of the things that I did hear this evening was about absolute return, right? That a manager was up, let's say 20% or 30%. Absolute numbers are impressive, but what we really look at internally is relative performance, right? And so let's say you're invested in an asset class and it's up 50% in a year, and you have a manager that's up 30%, right? 30% in and of itself, an absolute number, is fantastic, right? It's strong. But if the benchmark was up 50%, then you've got to wonder why they've lagged the benchmark. So that's how we go about internally evaluating managers. We look at each one of these variables on this page. I will say for you or I, that's just a lay retail investor, it's kind of hard to get through all of the items that are on this page, right? We have a separate manager due diligence team that looks at all of these things. But one of the things you can do, and I did hear this on the call this evening, was a lot of the retail platforms, they allow you to screen managers. So you can go in, pick Reits, right? And then look at the specific statistics that you want to look at. And it should be manager tenure. It should be performance. We can't talk about performance without risk. So you got to look at risk. And then you've got to look at the diversification in terms of property type and geographic type. Because you can imagine, right, that you don't want all your properties in New York, because New York was hit very, very hard by the pandemic, for example. You want that geographic diversification as well.
Hey, Mary, I was just going to add, I think in general, REITs as a category or class are not necessarily they can be complex, right? They're not necessarily as straightforward as some of the other asset classes. And when you going back to some of the questions before, a lot of the decision, or a lot of, as we have discussed in the past, a lot of the decisions around your investments really have to do with your own, what your own preferences are. A lot of individuals will choose REITs instead of direct real estate investments because there's a difference in terms of involvement and getting out of the investment. With the REIT, it's simply just liquidating that particular those shares, versus if you got real estate, you own real estate as an investment, there's a whole process that goes into that. And so I think it's one of those types of investments that probably takes a little bit more time to really understand, and a little bit more practice, because it's not something that is necessarily as intuitive as some of the other classes. And as Mary mentioned, there are qualities and characteristics that are attractive, especially if you're a little more risk averse and want to make sure that you've got a very certain bottom. Then REITs are probably a diversification strategy that you want to take a look at, versus going directly into traditional equities, because there really is no bottom there. So it's not, we've tried to have this conversation in about 30 minutes. And so the point is, it will take a couple of different revisits to this conversation, especially as you all go off and read up a little bit more about REITs. There are a number of websites that are out there that focus on REITs for beginners and give you a really, really good understanding and break down a lot of the terminology, to Adrian's point, that would be helpful But again, this is it's not a one and done type of discussion in terms of understanding the category or the asset class. It really has to be a discussion that's had a couple of times, and you build your knowledge around it as you move forward.
And I know some people are more comfortable with public REITs, right? Because they trade. You can trade them any time of the day, right? Whereas private REITs, you cannot. You have to ask for a redemption from the manager, and that redemption could take 3 months. It could take 6 months. And so there is a illiquidity premium there. And so typically you can get a little better return out of private REITs because of that.
So ladies, has this been helpful, or have we totally confused you this evening?
Yeah.
Both.
And again, this is, I think Jennifer and Adrian will tell you, this is one of those asset classes that most people really don't know about. I mean, we've got some pretty sophisticated individuals who do nothing other than manage REITs or invest in REITs all the time, and that's their expertise. So I guess my point is, I don't want you to walk away feeling as though you haven't gained anything from this part of the meeting or this discussion. I think what we were trying to do, and what Adrian and Jennifer were trying to do, was really just expose you to the class so that you'd understand that this is yet another tool that you'll have in your toolbox. It doesn't mean that you will learn it overnight, but the earlier we can get you acclimated to it and starting to read up on it and understand it, then what it means is, as you continue to grow your investment acumen and become more confident around investments, then at the right time, you'll be ready to really look at REITs seriously, and you'll just be more familiar with what they are and how to leverage them to create less unknown or less uncertainty in your overall investment strategy. Because that's really what you're trying to do at the end of the day. You're trying to manage the risk that you have for the dollars that you're investing by using a whole slew of different solutions that allow you to really minimize that risk.
Very good. We have a question in the chat from Julien. And let me see. Julien, do you want to just ask? You can unmute yourself and ask your question.
Sure, thank you. Mr. Would you go over the non-exchange traded REITs once more? I know you mentioned that public REITs are liquid, but where does the non-exchange traded REITs fall in the picture?
Yeah, so can we go back, Adrian? I don't know if we can pull that.
Yeah, we can. Yes, we can.
So are you talking about the middle box, Julien? Are you talking about right-handed?
The middle box, yes.
Yeah, so these are registered with the SEC, right? But they're just not available on exchange. So I would look at it this way: publicly traded, you've got a lot of information out there on it, right? It's very transparent. Non-exchange traded, they do have to register with the SEC, right? So there are certain rules that they have to follow around reporting, but you can't just walk in off the street as a retail investor and just buy it, right? Okay. And then the private would be, there's not a lot of transparency, right, on their valuations. And so that really, to invest in it, you really need to be a more sophisticated type of investor.
Thank you.
Mm-hmm.
And Julien, for the purposes of our investment club and our commitment to the bylaws, we're just going to be looking at publicly traded REITs for our purposes. That's going to be the easiest, and that's where you guys should focus. Mary and or Tiffany, can you guys talk about minimum investments? Can they go and purchase a REIT on Merrill Edge, on E-Trade, on SoFi? Are they available on most of your, retail trading platforms? And then
Yes.
what have you guys seen for minimum investments?
Yes, they are. I know you talked a lot about loads, right? And Class A and all that. If you belong on a particular platform, I would strongly, particularly if you're novices and you're getting started, strongly look at no loads, because a lot of them, when you're a client on their platform, they will have lists of no loads, right? So I would strongly consider those, and then you don't have to worry about the upfront load fees. But typically, particularly if you're going to do monthly type of investments, you can get in it very low. So you can get in it for like $100. There's not a high minimum. Whereas if you look at normally for a private REIT, you're talking about $10,000 or more. That's not the case with the public REIT. So think about it like you would a mutual fund. You can get in it pretty easily and pretty cheaply. Minimums are low. I didn't hear a lot about expense ratios, but expense ratios are important too. So I know there's a couple of you that talked about the S&P 500, and the expense ratio was 0.15 typically for an index fund. When we're looking at REITs, they tend to be a little bit more expensive because there's more to kind of manage the fund. So they tend to be, let's say, 0.75 to around 1.5 or so in terms of the expense ratio.
What other questions, ladies? Anything else on your minds? I feel like we've maybe created some confusion, or at least I see the brains working on this particular one, and give it time. Please give yourself some grace. This will come over time, and it's not something that anybody would expect. None of us sat down and learned this the first time. I mean, Adrian, Jennifer, Mary, myself, this was over time, because this is a little bit of a more complex solution because of how it is comprised and the rules around it. As Mary mentioned, I mean, they vary. They really do vary. And that's why Mary keeps pointing to, for this particular asset class, the importance of really looking at the manager and assessing the manager, just because you're talking about what in some instances are, unknown properties, right? And so their track record is really one of the things that you want to look at in terms of having less risk, controlling the risk, and having a little bit more consistency.
There's
I have a question.
Yeah, Iretta, you have your hand up?
Yeah. My question is, can we try to narrow the type of REIT by, say, category? Like, part of our philosophy and legacy builders is long-term post-pandemic. So, like, could we find REITs that are hotels and mainly hotels, resorts and stuff, instead of like retail space?
They would be harder to find. Okay. Because typically REITs tend to be diversified, although some of them may have geographic concentrations. But for your first investment into a REIT, I would look at something that's very diversified, right? So right now, hotels may not look that great as a holding as part of a REIT, but we know, because the vaccine rollout, that's going to change, right? So right now the valuations for that portion of the portfolio is pretty low, because those valuations for hotels have been beaten down. But we know that's going to change. So I wouldn't, like, for example, exclude that because we're in this current environment, right? I would think ahead. And so when I look at our outlook, Bank of America's outlook for this asset class, we are neutral. And the reason why we're neutral, because we know there's winners and we know there's losers. But I would not exclude a particular sector of the commercial real estate market, because we do believe it'll come back. It may take time for some more than others, but it will come back.
One thing I want to mention too, ladies, when we're talking about REITs, you know, we often think of a building as the structure, but we're really talking about real property. So you may find a REIT that is in, I know a couple of teams have a focus on technology. So it could be cell phone towers. It could be data warehouses that you might want to take a look at. So there are specialized REITs too, that by that within the sector may fit and be more aligned with your overall investment strategy. So really take a look at that as well. Okay, we have one.
I've got a question too.
Okay, so 2 questions, then we're gonna wrap up. Beth had her hand up. Simone, we're gonna go to you first, and then Beth will wrap up with you.
Okay, thanks. So I'll admit, REITs is not a familiar investment for me. It's not something I'm accustomed to hearing. So I guess what I'm kind of concerned about is typically after we have these calls and you guys give all these great presentations and you know, give us kind of a good starting point, we've been able to use Morningstar, and I know all of us on my team with the Blue Chicks, Spelman Blue Chicks, we all tend to use Fidelity for our research, which has been extremely helpful. And we use Morningstar quite a bit just to kind of help us. So those 2 alone has been extremely helpful. I'm just not real comfortable in knowing where I would start. And typically I just kind of jump on it like, you know, starting tomorrow. But right now I'm not quite sure where to go, to be honest.
Okay, so Morningstar should have a category entitled Reits, right?
Okay.
And so I'm not sure how you've been using category Morningstar to filter the funds, but one of the first things you could do if you're using Morningstar is go to the 5-star, right? So go to the ones that they've rated the kind of the best of the best, and you can start there and see what's in that category. You may even want to drop down 1 notch to 4 stars. And I would say really look at those 2 categories as a starting place for your search.
So am I able to use, well, we've been using Morningstar for ratings, that helps. But for the research, we have been using quite a bit like Fidelity, you know, for research and advice. And, you know, I think Yahoo Finance. So as far as research, I know you mentioned something about REITs for beginners. Is that a book, or exactly where would you suggest that we start just for research? Because for me, and from what I have gathered from my team, the research is what takes up the bulk amount of our time. So we just kind of want to know, how do we get a running start on this in terms of research?
Yeah, Mary, you want to take that one first and then I'll jump in?
Yeah, so beyond Morningstar, I would look at Yahoo Finance. I would look at, so if you're using Fidelity, I would use Fidelity. Typically those platforms, even though I'm not as familiar with Fidelity, they will have already done some of the screening for you, right? And they will narrow down, let's say, a handful of good REIT funds. And then what you do from there, I would say, is to take that information and then look at that last page that was in the presentation in terms of how to evaluate the manager. So some of the things your teams have already pointed out: how long has the manager been there? What's the return been? I would say relative return vis-a-vis the benchmark, right? What's the risk? So what's the volatility? And is the volatility in line with the benchmark? And if it's not, why? Have the returns been consistent? So those are the types of things that I would look at. And you could use that very last page of the presentation as a guide.
Okay. So you did say Fidelity. We could use that for research as well.
I'm not as familiar with Fidelity's website, but typically the retail websites, what you do is you run a screen, if you will, on Reits, right?
Okay.
And they'll list the Reits that they have on their that are approved for their platform.
Okay.
Now, it's not going to be like a large cap growth or a large cap value mutual fund. Typically, there's not that many Reits, right? So that I would anticipate, I'd be surprised if they even had 10 REIT mutual funds. It's probably going to be more like a handful, which makes it more manageable to research.
So
also offer what Mary included in her presentation. If you go to NAREIT, NAREIT.com, Simone, they'll break down where she had all of those different real estate categories. So you can kind of see, okay, do I want lodging? Do I want this, that, and the other? And it will give you kind of the benchmark for that portion of the sector as a place to start. And then I would go to your Morningstar to do your category search there, because then you'll have a benchmark to compare.
Okay. Yeah.
Thank you.
That is what I was going to recommend as a primary or at least initial place to start, the NAREIT site that Adrian just mentioned, because there's a lot more detail that you all can read about REITs in general. And it's kind of the industry standard. In addition, there's some other sites as well that really focus on walking you through as a beginner. And we can certainly share those with Adrian as well to provide.
Okay.
Okay, Beth, bring us home, Beth.
Okay, so I have 2 questions. One is, in my research in stocks, as it relates to dividends were usually more for blue chip companies, or those that had maturity, at least the higher end dividends. Is there a correlation in the REIT world of the dividends or the amount of dividends relative to the maturity of the REIT? So that's question 1. And then question 2 is, when we're analyzing a REIT and say it is for lodging, or it's for apartments or something like that, when you research, do you go into the weeds and take a look at what are the policies around security deposits, or when people fail to pay leases, and look to see if there's some advantages there that you might capitalize on in terms of payments, or is that too far into the weeds?
Yeah, so
far into the weeds.
Yeah, that is far into the weeds. But one of the things that we do look at in general is occupancy, right? So if the properties have low occupancies, then we know they're going to be devalued, right? So the next time they get that appraisal done, right, we know that appraisal is going to come back lower. So we do look at occupancy rates when we're looking at apartment buildings, office buildings, and like malls, that sort of thing. So we don't go that far into the weeds, but we keep it, let's say, 1 notch higher at occupancy rates. And then with regard to dividends, because there is a floor, if you will, on REITs, right? Remember that income component, right? That bond-like structure. It's not whether or not it's mature or not. It's what's going to throw off the income piece, right? The bond-like piece is what we're focused on. So it doesn't have to do with the maturity of the REIT. It really has to do with goes back to the occupancy of the REIT, because the rents, the income is what's going to generate that bond-like piece. Does that make sense?
Thank you. Yes, it does. Thank you.
Okay.
Jennifer, why don't you close us out tonight?
Thank you, Mary. Thank you, Tiffany, so much for the presentation. We really appreciate it and don't take it for granted. We know that having you guys here, normally to have access to this information, we would have to pay for it, right? So we truly appreciate your time, especially on Good Friday as we go into Easter weekend. So thank you so much. And ladies, this is a different asset class. It's a different animal, right? But I think what they have done a great job of talking about is that it's something that should work in conjunction with the other things that you are investing in, right? It's complementary and provides some diversification, but this is going to be a different animal for a lot of you in just how you think about it and how it looks versus what you have already done or what you've already invested in. Okay. And so, you know, thank you guys. Adrian, if you have anything additional, but other than that, again, any questions, I already know Simone is probably going to email me.
Yeah. I can see Simone over there holding her head, going like this. So we'll make sure that, as always, you will get a cheat sheet, ladies, so that it will help you through, step you through. If you're looking at the manager, what are the key things that you need to hone into so that you're able to put together your presentation? And just keep in mind, we're all learning. This is a
That's
test.
right.
There's no, you know, you pass or you fail. This is all giving you added information so that as you go on through your investment journey, you have a lot more insight as to what steps you can take. Okay, so with that, happy Resurrection Sunday. God bless you all. Good night, my Spelman sisters.
Good night. Thank you guys for everything. Good knowledge.